Hello everyone, welcome to the Money Club. My name is Zah, I am your host, and I'm joined by my friend, Sam. How are you?
Good Zah, how you doing?
Yeah, good. How's your week?
Probably not as busy as yours. I saw you flying around the countryside. I've just been helping clients myself. What about you? Where have you been? Where have you been?
Up north with the borders opened up now. It was really exciting. It was like 9 or 10 months worth of work into 3 days. It was a busy 3 days. I actually can't wait for our Christmas break, which brings us to a good point. Here we are at the end of the year.
Yeah.
I cannot believe it.
It's gone fast, huh?
Yeah.
Staying home and all that, you think time would go slow, but I think for those that were able to continue working, luckily for us, it has been very, very fast and very hectic.
I think it's a good thing that it's gone fast, because a lot of people are going to be, really, really happy that they can put 2020 behind them and really start this new decade that they wanted to start at the start of the year is going to start in 2021. And it looks like, our economic recovery is going quite strong. Australia really is the lucky country to be in. We read the news and listen to what's happening all over the world, and it's I'm really, really grateful that we're living here. Things aren't that bad.
Yeah, 2021 sounds very positive, and the economy sort of is dictated to by sentiment, right? So how people are feeling can help the economy recover and their positivity. So people are opening up their wallets now, they're investing, the property market's going quite well. So all signs are there for 2021 to be pretty good.
I feel like we're really on the cusp of a big boom, right? Like there's just so much money floating around in the economy right now. And as you said, Sam, confidence is one of those things where it's like that herd mentality where, the next door neighbor buys a new car, then you go and buy a new car, and it's just this domino effect, right? Because now we're driven so much by what's on social media, what's in the news. Everyone has access to up-to-date information. What happens is that, if the whole world is doing well, then we feel like we're doing well as well, and we spend money. If there's a lot of doom and gloom in the marketplace, then we pretty much know about it straight away. So it's either boom or bust in this new age economy. So I guess what we wanted to talk about today in our podcast is really close out, 2020, talk about some of the things that our listeners can do to prepare themselves for next year and also the next 10 years, right? Because this is a long-term game. So what we've come up here, Sam, is we've come up with a thing called the Money Club Blueprint, right? So an interesting fact to start off with is that, people spend the majority of their lives, building someone else's asset, right? And meaning that they're employees. And it's generally 90% of the working population, and the other 10% are the ones that are entrepreneurs, giving it a crack at investing and, small business and all of that sort of thing. So basically the Money Club Blueprint is very similar to our Robert Kiyosaki's cash flow quadrant. So I guess the reason why we've called it something different is because we feel like it is something different than how he explains it. So another interesting fact is a lot of our listeners will know that we are massive fans of Robert Kiyosaki. I think he's got like 20, 25 books out there. I've read them all, sometimes 2 or 3 times. And the cash flow quadrant, what it is, well, Sam, you tell us what the cash flow quadrant is.
The cash flow quadrant, it's pretty much showing you how different people derive their income, really. So there's the employee type section or quadrant where you're trading your time for income, which has a capped ability, right? So you're only limited to the amount of time in your day. So if you're going to try and progress in life, make more money, do more things, you might be capped. Next one is self-employed. Self-employed is where you're making a bit more money, but you're still more or less a worker. Then you can shift into business and an investor quadrant. So it's like a static model. I think Kiyosaki's one, still amazing. It's a good visual representation of how you can make different forms of money and income. But it's very static in that it's not giving you a path. It's not guiding you on how to say go from one quadrant to the other. It's just saying you might be in that quadrant and good luck to you. You may not be as successful as the other guy. Where we're trying to say, okay, mad quadrant setup. We want to see how we can get clients or people into the mentality to go through the quadrants so they can get to the investor stage or have passive income earlier than they.
Great. So the reason why we quote Kiyosaki in the first place is because, like you said, Sam, it's a great model.
Amazing.
Right? It's amazing. But what Kiyosaki fails to do is tell you how to transition from one to another, right? And like a lot of it is about shitting on employees, right? Which is not really it's not really a bad spot to be in if you're an employee, because a lot of our listeners are employees.
Everyone starts out as one.
Everyone starts out as one. You have to start out somewhere, right? And make your way to the investor sort of quadrant. So I guess what we've done is we've reworked it and sort of reworded it in a way where it's a bit more practical in terms of the steps and the transitions and where you should be, so you don't feel bad if you're in a certain quarter, right? Because Kiyosaki makes you actually feel bad, which isn't a bad thing because it forces you to change.
Could be motivational.
It forces you to change, right?
Yeah.
But let's just go back to the history of the cash flow quadrant, because a lot of people who are fans of Rich Dad Poor Dad think that he actually invented the quadrant.
He didn't.
But he didn't.
Oh.
Right?
Okay.
It was actually one of his advisors by the name of Keith Cunningham. Now, Keith Cunningham is a personal finance advisor, an old school one. Like he made big money in the 70s and the 80s, and he lost it all, and then he came back, and all the usual, rags to riches, riches to rags, and rags to riches story.
Yeah.
But I did a lot more research on behind the cash flow quadrant, and basically what Kiyosaki did was reskin what Keith Cunningham came up with, and then what he did was market it very well.
Went to the market with
because Kiyosaki is an excellent marketer, right? So that's how we know the cash flow quadrant today. So what I've done is done the same thing, right? I've reskinned it and I've tweaked it and I've made it a little bit more, I guess, simpler to understand for the general person who's just trying to do better in life. So we've called it the Money Club Blueprint.
You've made it more practical and I think more motivational. So his model, which like we said is amazing and is very informative about where you should be going and where you should be. But like you said, it did maybe hurt some feelings of some people. But
which is, again, a good thing maybe,
it is a
right?
good thing, but motivation can come from different sources. And if someone is maybe told that, they might react differently to someone else who might be motivated by that. So I think the model we've proposed and can put clients down that path is going to be a bit more accommodating to more people and help you along the path instead of just telling you where you are.
That's right, because I've actually seen Kiyosaki live, and he's a great presenter. As our listeners know, he's one of my favourite authors, and I've read all of his books and I consume all of his content. But when I saw him live, like, he was very, very adamant on telling people how bad they were if they were in specific quadrants, right? And I didn't like that, right? I was like, well, like you said, Sam, people have got to start somewhere. So let's drill down into this quadrant and this blueprint that we've come up with, right? So I like to think of it like an NBA game. So an NBA game, you've got quarters, right? So you've got 12 minutes per quarter. Now, how I relate that to the blueprint is that you've got 12 years per quarter. So from the time that you turn 18, that's when you start working, or you go to uni or whatever it is, right? Or you might do both.
Yep.
Now for 12 years, you're really sort of finding yourself professionally, personally. It's a really like foundational stage of we're talking about making money here. We're talking about life, and self-discovery, which is still
it goes hand in hand with
self-discovery, but we're talking about when you start earning money, right? So from 18 to 30, generally you're an employee. You've got to start somewhere. And sometimes you can fast track this blueprint. So for example, I've fast tracked it. So now at 36, I'm at the last quarter, right? But I understand that some people take longer. to progress through those quarters. So it's a really good guideline to get through. So, if you can be an employee for the first 12 years, then the second 12 years, you start transitioning to self-employed. So let's talk about just really, really briefly an example of self-employed people. What is it, Sam?
Oh, well, we had a client the other day that just transitioned. We met with him. I won't say his name, but he came in and he was looking to make that transition from an employee role into his own business. Not business, self-employed. So he doesn't have staff and say a brand to be a business yet, but he wants to shift into that space, and that space in between is self-employment. So he's now his own contractor. So you're moving away from working for someone to working for yourself, more or less. That's the basics.
So basically you're opening a business, a self-employed business, but you're sort of starting a more glorified job for yourself, which is not a bad thing, right? You've got to start making that transition. Then, you've got the third quarter, which is, the next 12 years, which is generally business. And business is something like, it's not, a lot of people get confused between self-employed business and actual business.
So an example of a transition from an employee to a self-employed could be the case of, say, a doctor working for a practice, and we had many of these over time, where they go and do their own thing, set up their own medical practice somewhere else and work for themselves. Instead of now working for a wage that they used to get, say, $100 an hour for a doctor, maybe more, they get that, instead of that wage, they can charge out their normal charge out rate of $400, and they'll pocket the profit instead of the medical practice they used to work for. So you're getting the profit that business was making off you once you're in self-employed. But you're not a business as such, you're just working for yourself.
Yes, and so I think a lot of people get this mixed up with the business quarter, right? Because the business quarter is the next quarter where, self-employed and business is different, because actual business means that you can step away from your business and it runs without you.
Correct.
So, for example, I have a hair salon. I don't actually cut hair, but I can step away from the business because I've set up the business to be able to be run by other employees. Correct. Right? We've got managers in place, we've got hairdressers in place, we've got suppliers in place, and the system's been set up. So it's almost like a McDonald's where it just runs. That allows me to step back from it and work on other things, or just not work at all. Like, I've got the choice, right? But where you want to go from there, again, right? Some people spend a lot of time in that business quarter because it's probably the most fulfilling and the most high yielding and returning.
Most lucrative.
Yeah.
You make a lot of money, right?
Yeah, but you still pay some sort of tax. You still are faced with a similar problem that you have with the other previous quarters. So you want to go into the most passive quarter, which is the investor quarter. And that's where, you look at things like real estate, stocks and all of that sort of thing.
Good point you touched on. So that transition from the self-employed, working for yourself, to then the business owner, in your case, the salon, systems are needed. We've seen this a lot when we're dealing with our clients that are self-employed and trying to expand. They don't have systems in place, they don't have resources. So when you're in business, you're leveraging other people's time, their time in the day, you're leveraging money, you're leveraging a brand, assets and things like that for that business to operate on its own without you. So a lot of the time, people transitioning from the self-employed to business may fail or take too long because they don't have the systems in place to allow that transition to occur, and they're stuck working in the business. You see that a lot with accountants in my industry, in our industry. They're so fixated on dealing with the client that they want to deal with the client all the time, when sometimes you have to step away, manage the business from the top and allow your managers to handle the client. Otherwise, you're going to be another worker in your own business, which is not what you want to do.
And you touched on something really interesting there. Sometimes people take too long to transition, right? And this is the reason why we're doing this podcast, because I've gone super quick into this business and investor
you jumped in.
Yeah, stage. And I was super obsessed with getting through it as quickly as I could, because I didn't want to stay in the employee quadrant for too long. I didn't want to stay in the self-employed quadrant for too long, and I still hold characteristics within each of those quadrants, right? But it's really important to keep evolving and keep moving and keep learning and trying to get to that next level. And it's not about more. It's just about how can I get to the next stage but remain sustainable, right? Because we don't want to pressure people to go, look, grow. You know that old saying, you know, if you're not growing, you're dying. And I actually don't believe in that, because, yeah, you've got to grow, but you've also got to evolve.
Okay.
And you've also got to be sustainable in your growth. There's no point growing into the business quadrant if you haven't acquired the skills in the self-employed quadrant. You've got to go through the stages. And even though my transition has been super quick, it might not be as quick for, say, someone like you or someone else, you know what I mean? Everybody's different. So it's really important that you go, okay, what's the blueprint? What's the plan? What's the strategy? Let's just get to work. Let's not beat ourselves up over still being an employee. And let's not beat up ourselves up so hard when we're, you know, failing at a business, right? We may have to go back to the self-employed stage and go, let's get back to basics. Let's work on the fundamentals and then start upgrading our skill set so we can move to the next stage. And the problem is, we listen to guys like Robert Kiyosaki, for example, and he goes, employees and self-employed are dummies, right? And business owners and investors, they're the cream. They're the people at the top. They're the people that are going to win. And it's true, but what about the dummies that are stuck in those quadrants? What have they got to do?
Half of his audience is in that dummy section, which it's just not I don't think a nice way to address them. And they're going to progress into that stage, so into business and things. So yeah, no, it's a path that I think is good to be aware of and know where you are. Get people on board to help you see where you are and plan steps for you to enter that new phase.
I think the problem that we have with financial advice and this industry of accounting and business coaching and all of that sort of thing, it's run by a lot of old white people. You know what I mean? Like they're like in their 70s. They've done quite well.
Yeah.
Robert Kiyosaki, you know, he's done obviously well for himself. He's in his 70s, and I think he's lost touch with the people at the bottom. And it's, you know, it's nothing against people like that. It naturally happens. I'm sure I'll get like that when I get to that age, right? And to that level of success.
Yeah.
You will lose touch about Generation Z because you're so far away, right? So I guess that's why we've got podcasts like this where we're millennials ourselves, right? We are that bridging gap to be able to go, okay, look, we understand how hard it is to be 20, 21 years old. Let me tell you how we did it, right? Yes, you got to listen to these gurus who are in their 70s and 80s, but you know what? Life's different, man.
Oh, 100%.
You know what I mean?
We've talked about a lot how what you used to be able to do back in the day is redundant now. So I think Kiyosaki might not be giving you a plan on how to get to where he is now, because his plan doesn't exist anymore. So I think you have to be listening or dealing with people that are doing what you're trying to do, because they're the ones that are going to support you and guide you to the next stages.
But on Kiyosaki and all of those older guys that are in the industry, what's on their side are the fundamentals. The fundamentals never change. And that's why Kiyosaki's content is so relevant, because it gives you that mindset shift that you really, really need to deploy in the current marketplace. But now you've just got to learn it a lot faster. Which brings me to my next point. The Australian dream, which is similar to the American dream, right? Now, let's just define what the Australian dream is, right? The Australian dream is, to me, is like, I come from, migrant parents, and so do you. And, our parents fled their countries because there was not much opportunity there to come to Australia.
For the Australian dream.
For the Australian dream, right? And what that means is that about 150, 200 years ago, in Asia and Europe, where our parents are from, there were two distinct classes, poor and the rich, right? And what happens with the poor and the rich is that when you're born poor, back in Asia and Europe, back a couple of hundred years ago.
Older civilization.
Yeah, you accept that
Yep.
you're going to be poor. There was actually no way that you could go into the rich category. It was just two classes of people. That's it, right? Now, the Australian dream, which is also known as the American dream, is about equality.
Land of opportunity.
The land of opportunity. Everyone can buy a home. Everyone can build wealth. Everyone can build a business. It's great. Like, I'm very grateful to be living here. But the problem that we have is that the American dream, for example, like, we're not too far behind America.
Yeah.
The American dream is now becoming obsolete.
Dead.
Right? The American dollar is quite weak. It's only going to get weaker with all the money that they're printing. And now in America, these distinct classes. Now, Australia, not too far behind. COVID has accelerated this. So now the Australian dream of, what is it? Going to school, get a job, save some money.
Yeah. Buy a home.
Buy a home.
Yeah, have the kids.
Have the kids, all of that sort of
Have a
thing.
holiday every now and then.
What's going to happen now is that housing affordability is getting away from first home buyers. If you're not in the market and you are born into a family that aren't in the market, what's going to happen is those people are just going to accept that they'll never ever build wealth because it's getting too far away. Just like Asia is today.
Yes.
Just like Europe is today. People grow up going, I'm going to rent for the rest of my life. I'm never going to own property. But I'm happy with that. I'm cool with that.
It's a fact.
They just accept it,
now.
right? In Australia, they're starting to now accept
It's getting to that point.
It's getting to that point.
Yeah.
Meaning, what do we got to do, Sam?
Act. Pretty much, you have to act. Interesting. I listened to another podcast, and this speaker was going on about pretty much that shift and the changing of say society in an emerging country. And I think he was referring to Australia, but it would apply to all countries pretty much over time. He was saying how back in the 50s in Australia, the male was going to work. The wife would stay at home back then, in those days. That male would go to work in a factory, more or less a very unskilled job, not high paying. He was able to fund the family life, buy the home, have a car, go on holidays every year on that one factory type wage. Now we're in 2020 and we have professionals in the cities making pretty decent money with no kids, still struggling to buy a home. So they were saying how really that change or the affluence we think we have isn't really there, because that guy back in the 50s was a sole income. He could do everything he wanted to do. Where nowadays you can't do it with two people.
And it's the reason why house prices went up so much, right? I think it was in the, 80s or 90s when house prices really grew. It's because the wife ended up working. So then we've got these double income households.
Yep.
And now it's a normal thing, right? It's a normal thing for your spouse to work as well as you. And because to keep up with the Kardashians, you need to, right?
Money.
You have to get that extra source of income. And as soon as your kids are old enough to earn money, get them to work as well. So you got triple income. That's what I'll be doing. And it's just the truth.
So life's changed since back then. You can't get the father can't go earn the income to support the family anymore to pay for the house. You need a couple to make money and struggle sometimes to buy the house.
And up until recently, just buying the home seemed to be enough. But now we understand. Now, I've got clients who are in their 40s and their 50s, and all they've done is invest into their home, and they might have a great $2-3 million home, but that's all they have, right? Doesn't produce any income. They can't retire off it, right? So, what do we got to do, Sam? Right? We've got to go. Okay, well, is it the blueprint?
Well, the blueprint is there to go down that path. I think it's a very logical stepping stone throughout life relating to money. If you cannot get out of the employee space, it's not the end of the world, okay? If you can't get out of the self-employed space, it's not the end of the world, business space, so on and so forth. I think what we really need to drive home to our listeners is to try and progress. If you cannot, still think about the investing space, because regardless of your space within employee, self-employed and business, all throughout those stages, investing in assets yourself, that sort of mentality is going to help you speed up that process anyway and have a more larger asset size come retirement, right? So we want you to go down those paths, but if you can't, still don't forget about investing. You have to do that.
So let's say someone is listening to this,
Yes.
they're an employee, which is highly likely, and we're not saying that being an employee is bad, because employees make the world go around. You know, like some of my best friends are employees. I've got some really good employees that work for me. What can they do, Sam, to keep, I guess, reinvesting into themselves to make sure that, okay, they're not stuck in that quadrant, but they're still moving forward?
Okay.
What are some of the things that they can do?
You'd be investing in yourself, so spending money on your education. If you're wanting to go down that the blueprint path, you more or less would need to be in an industry where you're able to build a business. Some roles that employees have, like say for a call center, if you work in a call center, it might be hard to set up your own business, right? So I think try and find something you enjoy doing, spend time and money on that skill, develop it, and get experience. Experience, time in the game is going to create the value in that field. From that employee perspective, that's then your next step into self-employment.
So you got to continue to invest in yourself, right?
Constant.
Upskilling yourself
Constant.
and to keep moving forward.
Yeah.
But I guess some people don't want to be self-employed. They don't want the burden of responsibility and the liability, right?
Risk.
And the lack of security, because they might have a mortgage or they might have 3 kids at home, wife doesn't work, all of those sort of things. So being an employee isn't necessarily that bad. It's just like renting a house. Renting a house isn't bad. Like if it's allowing you to live in a place where, you know, you can get a lot more done, right? Then why would you settle buying for something out 100 kilometers away from, you know, where all your life is? So there's pros and cons, but you need to work it to your advantage. I see a lot of people as employees, they actually have good jobs. There's a lot of good growth prospects as well. So I think, you know, what they should do is continue to reinvest in themselves, but be entrepreneurs within their space. I think they call it intrapreneurs. Intrapreneurs, right?
Yeah.
Whereas they have the entrepreneurial mindset within someone else's business. So, you know, they're delivering a tremendous amount of value, and in return, they're getting promotions, they're getting more money. And like, let's just talk about some of the advantages of being an employee. As we know, banks love employees.
Stability. It's stability. Stable income. If you've been there a long time, even more love you get from the bank. Taxes and all the admin stuff that self-employed people have to do, they don't have to do. If you lose a client, it's not going to affect your salary. So there's a lot of pros to being an employee.
So let's just cover off on that.
Yeah.
Employee, stay in that quadrant, but you still, like, it's mandatory to go to the investment, right? The investor.
Correct.
So you can skip self-employed and business and go straight to the investor, right? And actually do quite well, because the banks are willing to give you money. We call the pay slip a pay-as-you-go pay slip full time. We call that in our industry a golden ticket.
Golden ticket.
The golden ticket, because you got to compare that to if you were self-employed. What do you got to do, Sam, if you're self-employed, generally speaking, to get a loan from the bank to buy an investment property?
For financing, if you're self-employed, you more or less need to show 2 years worth of business activity. Now, if you're just starting out and the first year's not that great, that could impact your serviceability.
Which is generally the truth most of the time, right? Starting a business from the very beginning, usually you fall on your face for the first 2 or 3 years.
100%.
Like, I didn't really make it big in business after about 10 years.
Okay.
Right? So for me, it's like been mistake after mistake after mistake after mistake. And, you know, like, it's hard to get loans. It's hard to be an investor.
Your first-hand experience. So
Yeah.
throughout those entrepreneurial years where you're in business, was it very difficult to get a loan?
100%.
How much admin and
Even
stuff.
when lending was actually quite, they were giving,
Quite loose,
yeah,
they're
they were
throwing money
quite
around.
lenient with their criteria.
Yeah.
It was still hard for me. Like there were plenty of times where I needed to utilise Jade's payslip and my wife,
The golden ticket.
right, the golden ticket,
To get something across the line.
And you know what? Even if I was making more money than her wage,
That's interesting.
it was harder to get loans. But because I had the golden ticket,
Yep.
I was able to get the loans. So, in concluding that conversation, if you're an employee and you're full time, utilize that golden ticket. You're paying, what's the average tax bracket that?
Oh, say on 100 grand, you're paying, say, 27 cents.
So
27%.
let's say 30%.
Yeah,
Right?
30%.
You're paying 30% in taxes a year. So out of 100 grand, you're paying $33,000 in taxes. Why wouldn't you utilize that, right? So if you're an employee and you don't plan on, jumping to self-employed or to own your own business, you just don't have that vision, then at least have the vision to invest, right? Have the vision to utilize the golden ticket, which is also known as your pay slip, to go in to a property or into whatever investment we're talking about. So we're not talking specifically about asset classes.
Yep.
We're just talking about being an investor to achieve that passive income. There's no reason why you can't work in a job for 15, 20 years, for example, and own 10 properties. There's no reason why you
We've
can't.
got lots of clients that are in that position.
100%.
So you can operate outside of one quadrant is what a good point is making. So you don't have to be defined to one segment. You can operate very effectively as an employee whilst investing. So I think that's what we're trying to get across to people is that try go down that path and your ultimate goal is to be purely investing, right? So you're not spending any of your time. But regardless where you are in that and where you want to be in that path, still invest. You are investing by default through super. Don't forget, generally speaking, if you're an employee, you're putting super away through the business is paying for. If you're in business, generally you're doing that for tax breaks and things like that. So you're already by default being an investor. But that investment, depending what you do with it, it may not give you enough come retirement to live quite plush. Right? So you need to do your own investing. The government set up super because they know we don't invest, generally speaking. So they're forcing us to invest. So they know the importance of investing. So why not amplify that and do it ourselves so when we come to retirement, we've got double what we could have had.
And I think the misconception with super is that it's so far away, especially for our millennials that listen to us. Like I know people who have withdrawn, $10,000, $20,000. If they're a couple, it's 40 grand as much, right, from their super. And the problem is that's the only thing that they're investing in at the moment, right? Because anyone who's an investor knows that that's a stupid move.
Oh.
So we need to understand that superannuation, as boring as it is, and you can't access it till 65, unless you've got a really good strategy and plan to make money, like me, then don't tinker with it, because that's the only thing that you're going to fall back on. Now, I want to move on from the employee, right? Because it's sort of like, yes, we've talked to that percentage of the population, which is the majority, but I want to get to the more exciting stuff. Self-employed people transitioning to business, right? Which is the second quarter to the third quarter. A lot of people don't do it. A lot of people don't look at doing it because they bullshit themselves to think that, okay, I'm a business owner at self-employed, but you're really not, because you're trading time for money. You've traded a boss for a client, which is still your boss.
I still give you the shits.
Now you've got multiple bosses, right? You've gone from one dickhead boss, to multiple dickhead bosses, right? And that's just basically how it works when you're self-employed. So a lot of people go, you know what? I'm sick of this shit. I'm going to step away, right? I now need to scale. Now I need to leverage others to do the work for me, because we don't want to be held at gunpoint. When we've worked so hard to go from employee to self-employed, we bullshit ourselves thinking, oh, we're entrepreneurs and we can do we're our own boss and we choose our own times and we're very, very flexible and all, but really you're just a glorified employee.
Comes back to why you're doing it. Why are you going into business? Why did you go away from employee to self-employed? More or less for more money, more autonomy. Right? You have more free time, but you can make more money at the same time, generally speaking. To then shift into business is taking that to the next level. So it's you're following that path towards more autonomy and more money. So it only makes sense to get into the business position. But there's a lot of hurdles, and I think people just don't know how to do it. Maybe
It's hard.
They continue working in it, right? So depending on what business you're in, you may be required to do the work. You might be the face of the business, and so on. So it might be hard for you to scale people underneath you. So really, you just have to look at where your value is and try and only do that component and help get others to help you do the other stuff.
And it's a very small percentage of the population who go from the second to the third, which is from self-employed to business, right? And look, I've done it all. So I know what's involved, and I know the mindset shifts that you have to go through psychologically.
That's probably the most important, would you say? The mindset?
100%, because you've got to figure out, okay, what is your position in this whole blueprint, right? Because what the biggest mistakes self-employed people do is they get so good at what they do, they get so specialized at what they do, is that they feel that, okay, if I step away, then no one else can do this job. Yes. Now, what I've always concentrated on doing is being a generalist, where I know a little bit about everything, but I can control everything, right? And then I just hire the smartest people, you know, within my circle to go, okay, you're going to do this, you're going to do that, that's your role. And I've got all of this team of people that can do my work for me, right? While at the same time, I can sit above it, work on the business, and basically go on holidays whenever I want. That's the ultimate goal. You don't want to be tied to your desk forever, right? Being a self-employed person, doing all of the work yourself, pedaling very fast. And yes, you're earning good money, but money's only one side of the equation. You will burn out. You will feel like shit. You won't be fulfilled for the rest of your life. You'll start resenting your work, right? So what you want to do is start transitioning out into the business side. Hire other people like yourself. Hire people to do the work. Leverage off them. Scale so you can expand, right? Because you've only got 24 hours in a day. You want to be able to do, 1,000 hours worth of work in one day. And you're not going to be able to do that self-employed.
100%. It sounds like you have to shift from what you're saying. I just thought of it now. You have to shift from the hard work to your network. So you've already done the hard work. You've built the brand. You've built your reputation. Now you have to use the network within to build your business and your customer base and be that pivot point between the two, right? So instead of working in it, you're working on it, and your value is now the face of the brand, the consultations and things like that, not doing the grinding work. If you can do that, then you're on your road to success, more or less.
The key word being your network. Your network is your net worth, right? And I guess a lot of people look at rich people and people with money who are entrepreneurs who do really well, and they look at them as greedy. But in actual fact, a lot of these business owners and investors are very generous people. Like they give a lot. They give a lot because they know that they've got to give to their network so that network can do the work for them so that they can step back. It's exactly what I've done. I've given a lot. Some people look at me and they go, Zah, you're too generous. Yep. Like you give away too much. And there are times where I do give away too much. And people take advantage of that. However, on the back end, I've got a very strong network that will go to war with me. You know what I mean? I've got soldiers behind me pushing me forward, even if I'm going in the wrong direction. They're like, "No worries, we're going this way. We're going this way." And then I can turn around and go, "Hang on, I think I'm going the wrong way. We now need to go this way." And you know what? They'll follow. They'll go, "No worries, we'll go this way," because I've looked after them so well. They're so well fed that they're going to help me. They're going to help me get to where I want to go. And that's exactly what self-employed people need to do. They've got to let go, give a little bit back, right? Invest in their network so they can move to that next quadrant. Now, once you move to that next quadrant and you make more money, obviously we do it for money, right? Make that money and put it into investments. Now, what I want to talk about, because we've moved through all of the quadrants, tax.
Yes.
The most exciting part of this conversation. Because what happens when you go from employee, self-employed to business to investor, the tax implications, right? Because we all know employees pay the most in tax.
And you're paying it first. So as an employee,
you don't have the choice, right?
No, they take it first before you even get your money, right? So As an employee, when you get your pay slip, you're only seeing the net pay. You're not seeing the tax that's going to the ATO before you even get your net pay. So they're taxing you first, which is a lot of the videos online would say that's the biggest expense that you're having. So as an employee, you're getting hammered. You're getting hammered with tax. The more you earn, even though you're a gun, $500,000 salary. I've got clients on $1 million salaries. They're paying $400,000 in tax.
Wow.
$400,000 in tax. So it's massive, massive tax implications staying in the employee role.
The highest tax bracket is what?
47 cents.
In terms of the earnings?
Above 180.
So 180.
Above 180.
Which is not that much money. 180 grand's not that much money.
Not really.
Like we've got professional footballers, you know, who are clients of ours who are on $500,000 a year and they're taking home 250 grand.
Yeah.
You know what I mean?
So big tax implication. That's why investing is good. There's tax benefits to do investing, tax breaks and things like that if you're in an employee space, which is why we're telling people invest not only for the future but for tax reasons. Self-employed is then you have the bit of more power in terms of the tax. When you're in business, you are filing more or less your own tax returns and paying yourself. So there are ways that you can delay payments of tax to the ATO. And if you have a good accountant, they can help you even more. Self-employed and business.
I know one.
If you need one, just email us. Self-employed and business are quite similar. You have a lot more flexibility with the tax situation. In business, there's probably more structuring you can do, a bit more creativity you can employ. So yeah, there's a lot more tax implications in those three quadrants. Once you're investing, you're still going to have a tax implication. That passive income you're getting is going to be taxed, but those equity gains you're getting that you're able to tap into, it's like getting income that you don't have to pay tax on to then redeploy. So equity growth in your portfolio, whether that's property, other types of investments, you can tap into that tax-free, like a lot of property investors would have done, and then redeploy that into another asset with no tax implication.
So let's give an example, Sam, right? So our 10-year acquisition strategy over at Luxland is to buy 10 properties in 10 years, and hopefully that portfolio is going to be worth, you know, say around $7 to $10 million. So let's say it's worth 10 million, just so we can use it as an example. You got $10 million worth of property, and you know it goes up by 10%. You go back to the bank and you refinance it, and you go, okay, there's $1 million worth of equity there, which is, you know, the portfolio is now worth 11 million, right? And the bank goes, okay, well, we'll give you 80% of that profit margin of $1 million. So you've effectively tapped into $800,000 worth of money, right? That you can basically use for anything if you're creative enough with the banks and your accounting and all of that sort of thing. And you haven't had to work for it, right? It's passive and it's tax-free. Mm-hmm. So it's like you get this double advantage when you are, or you've got a lot more advantages, but those main two double advantages is that when you're an employee, you're taxed the most, right? Yep. You work the hardest, yes. Right? It's really, really tough, but that's what people know to do. That's what you grow up, you know, knowing what to do. Schools teach you to be an employee. Not necessarily a bad thing, but you've got to learn, okay, how do I get out of that quadrant into the investor quadrant or self-employed in business, right? You need to learn how to move. You've got to be agile. You can't be rigid and just this robot that goes to work every day. You're going to blow your brains out. It's not going to achieve the Australian dream that we're all striving to achieve, right? You're not going to move from poor to rich if you just stay within that mindset. Even your clients that you're talking about that earn $1 million and they, you know, they pay 400 or 500 grand in tax. Even those people, okay, they've got $500K to spend on living expenses and whatever throughout the year. They're not going to be left with much, right? Like it sounds like a lot of money, but you're not going to be left with much. You need to be making money in your sleep. You need to be making money from your investments passively.
What tax and investing go hand in hand. So there's a lot of tax benefits. Just quickly, if you make a loss in an investment, it's deductible against your income, right? So the ATO, the government, are subsidising a loss you might be making on an investment. ATO is giving you money if you make a loss. So rental properties with depreciation that are giving you a loss. You could have cash flow positive income, have a depreciation schedule giving you a negative result in your tax return. ATO is giving you money on that.
It's a gift.
It's free money. So investing will give you that loss, right? Tax benefit. The equity gain is then tax-free to use to grow your portfolio. And then if you ever need to sell something, the ATO rewards investors by giving you a 50% discount on the capital gain. So they're sort of telling you, invest, will give you discounts on tax. That's what they're telling you to do. So do it.
It's simple for us, Sam, because we know it, right? So, breaking all of that down for our listeners who are new to this podcast and new to accounting and all of that sort of thing. And when we talk about accounting, right, let's Warren Buffett. Everybody knows Warren Buffett. Warren Buffett says that the success in business is knowing the language of accounting. Yep. That's what he says.
Numbers.
It's numbers, right? And you've got to learn them. You really do. It's financial literacy, and this is what's going to help you move from quarter to quarter to quarter. And you need to keep evolving. You need to keep growing. If you stay if you stay in the one quarter and you don't even move to the investor and you just stay an employee, right? You will die. You have to move. Make a decision. You have to move. If you stay an employee at 40 years old and you're still not investing, right? It's like staying in primary school and not graduating to high school.
You keep repeating.
You're still a kid.
Keep repeating.
Yeah, you're one of those spastics that keep repeating, right? Like you need to keep moving forward. You need to learn how to transition. That's a bit harsh, but look, it's the truth, right? You don't want to be one of those obsolete guys.
Yes.
Right?
Made redundant.
We have so many people who do really, really well in the employee quadrant, right? But what happens, because they do so well, at 40, 45 years old, they're still basking in those glory days of going, yeah, I won the grand final in high school.
Oh.
You know what I mean? Like one of those guys. You don't want to be one of those
glory
guys.
days are behind.
You want to talk about what are you going to be in the future? What are you working towards? When are you going to move from employee to self-employed or employee to investor? What are your plans? Who are you listening to? Who are you engaging? Is it Sam? Is it Zar? Is it someone else? Start talking to people about these ideas. Start strategizing how you're going to move forward. Surround yourself with people who are on the same path.
Doing the same thing.
Right? Don't go down to the pub and drink with your mates on a Friday night or on a Tuesday night, whatever it is that's not going to get you anywhere.
Bring you down. They don't want you to succeed.
That's it. The crab in the bucket analogy, right? Like, don't be around those people. We have people in our family who hate our guts because of our success. They are not supportive at all. So you know what we do? We just don't hang out with them. We don't even go to family events because we know these people are going to be there, and we just go, you know what? Fuck them. We're not going to deal with them, right? Yeah, they're blood. Yeah, we got to love them. But you know what? Do the minimum with those people. I want to hang out with people like you, Sam, who want to get ahead. I want to hang out with other people that are driving their business forward, that are doing new things, that are evolving. Now is a better time than never, right? We've got access to all the information. We've got, you don't even need to go to school. Like you can learn it on YouTube. Learn it from this podcast. That's all you got to listen to. Just tune in.
Listen to them all. No, 100%.
So I think that brings us up to the final.
The final, yes. What's the final?
The final point is that we always need to be striving to get to the investor.
I think we touched on it a lot. Don't limit yourself to one quarter. If you can go to self-employed, do it. If you can go to business, do it. Maybe try and use that as your motivator to progress, but don't forget about investing. Regardless where you are, there's a lot of benefit to doing that, and continue to try and do that.
Well, like we've always talked about, we're not going to go into it with cheap money and all of that sort of thing. The way our parents did it 20, 30, 40 years ago, it's obsolete. Like we cannot achieve the same result. So if you're not being proactive and doing the things that say we're doing, and Generation Z, they're going to have to start a lot earlier. So I'm telling people who are 21, 22 years old, get into the market, start working on skill sets to get you there. Even if you don't invest, learn what you've got to do. Come up with a plan. We get a lot of people saying to us, Zar, when I've got money, I'll come and see you. No, you've got to come and see me now so that you can go, okay, when I've got money, I know what to do. right? You need a plan, you
Yes.
need targets, all of those sort of things. So an interesting point with targets, you know, start setting your targets now for 2021. Like, now's the time to do the preparation so you can hit the ground running come January 1st.
Make the most of it.
Don't get to January 1st and just have a hangover. Get to January 1st
With a plan.
Have a hangover and a plan, right? So that you know what you got to do, you know, come the new year. So I guess that wraps us up for our final podcast for 2020. I would like to just thank our listeners for all of the support that they've given us this year. It's been amazing. Like, we haven't been doing this long in terms of the Money Club podcast. And Sam, I want to take my hat off to you. I think you've done really, really well. I know, you jumped into the deep end this year with getting on camera and all of that sort of thing. And I think your progression has been amazing. I'm very proud of you.
Thank you, mate.
And I'm looking forward to a big year together, and with our listeners as well. We want to thank you guys for all your support. And look, have a Merry Christmas.
Yep.
Happy New Year. And all the best for 2021. We'll see you then.
See you guys.